You are an exporter, you have landed a big order. The buyer is real, the contract is signed. Now the LC is in your hand. But here's the problem. You need 50 lakhs to buy raw material, pay your workers, and get those goods ready to ship. Now the money is literally sitting in the form of that export order in your hand. But actually money hasn't arrived yet. Now this is exactly the gap that we call as the pre-shipment finance, often by the name packing credit, is designed to fill. And now in my this video I'm going to take you inside the mind of a banker to show you exactly how this packing credit works and who qualifies for it, what actually bank looks for, and the mistakes that get your many times application rejected. Hi, my name is Sangeeta Sharma and I have spent 11 years as a credit officer in a public sector bank evaluating thousands of business finance proposals. So, what you are getting here is not some textbook theory, but it's actually what is happening at the bank's credit desk. Now, if you are an exporter or a banker, this video can save you months of confusion. Now, if you are a banker, then this is a solid refresher on how to structure and sanction a PC, that is packing credit limit, properly. So grab your chair, let's get started. Now, so what exactly is packing credit according to you? Now, packing credit is just a short form of working capital loan. Now, it is given by a bank to an exporter. Now, this is a specifically finance done for the production or maybe procurement of goods that are going to be exported, right? Now, you can think of it like this way. You have an export order, okay? Now, this order is your proof of future income. Now, this order will generate your future income, and the bank essentially advances just money against your this future income so that you can pack the goods and ship them. Now that's why this is called as packing credit. Simple. Now you are getting funded to get the goods packed and ready. Now here's a key RBI definition. Now pre-shipment credit means any loan or simply advance granted to an exporter for just financing the purchase or maybe processing, manufacturing or packaging of goods prior to shipment. Now see, this is your export order, okay? Now you get a packing credit limit. Now you manufacture the product, make it ready for shipment, that is you pack your good prior to shipment, right? Now this money which you get here to process this order, that is called packing credit. Now, and most importantly, this falls under priority sector lending in India. Now this means that banks have a regulatory incentive to lend to exporters, and that's literally a good news for you, right? Now packing credit is not the same as just your working capital loan, that is your CC limit, right? Now it's specifically tied to an export transaction that is going to take place. Now the bank will want to see an underlying trade document, usually we call it as letter of credit, a confirmed export order, before they sanction you a proper limit for packing credit, okay? Now here's the most important thing to understand. Now packing credit is self liquidating. That means once you ship your goods, your good is shipped now, right? And you present the document that you have exported the good, and you have just shipped the good, you present all the document. Now the export proceeds automatically will repay your packing credit, right? As you will get the payment from your importer, your packing credit will be repaid through that payment, and now the loan cleans itself up, right? That's actually why banks love this packing credit limit. There's a clear repayment mechanism that is built to pay itself, right? Okay. Now, packaging credit is not just one size fits all. It depends on where your export order stands and how you need the funds. There are different types. Let me walk you through each one and you will understand it clearly. Now the first one is clean packing credit limit. Now this is the simplest form of packing credit limit. The bank will give you the loan based on just your export order and LC document without any hypothecation of your goods at this stage, right? This is physically given to, say, a well-rated, old, trusted borrowers with an established relationship with the bank. Now, if you are applying for the packing credit for the first time, bank will, it's a rare chance, say, hardly 10% chance that bank will give you this limit. Okay. And now the second one comes is packing credit against hypothecation of goods. This is the most usual one. Here you receive the funds, but your goods that you purchase or manufactures are hypothecated, which means that your goods are pledged to the bank. Okay, the bank has a charge over the goods and they may conduct any type inspection, that you have seen bank officials coming to a unit, and this is the most common form of packing credit which you usually get from the bank. Now the next is packing credit against hypothecation or say pledge of goods. Okay, now this is a little bit stricter than other two. The goods are physically pledged, meaning they are stored in a warehouse under the bank's control or say with a third party collateral mortgager. Now bank use this when they need say tighter security over the inventory, and it's mostly common in commodity based exports, not in day to day which we see. And now type 4 is packing credit against red clause LC. Now this is basically a special type of LC and often called as red clause LC, where the foreign buyer's bank has specially authorized an advance payment to you before the shipment of good. Now the bank is essentially pre-funding the exporter on behalf of the importer. Now this shifts the risk. So red clause LCs are seen as the stronger security. Here you don't need any security, right? Now next is type 5, that is advance against duty drawback and exporters incentives. Now what is this? Now sometimes you have heard that exporters are entitled to receive some duty drawback or maybe government incentives after export. Now banks can give you an advance against these receivables. Yes, you get an advance against these receivables, right? Now and this usually runs on as a separate facility other than from your packing credit. Now here is a pro tip for exporters. When you approach your bank, now the type of tracking credit you will get depends on your credit rating, the nature of your goods, what goods are you manufacturing or maybe you are exporting, and the most important, your relationship with bank. So don't accept the most restrictive type by default. Okay, you have your right to negotiate them, correct? Now next is the question is, let's talk about the two things that exporters usually want to know: how long does the loan last and what the interest rate will I repay. Okay, now what is tenor? Tenor packing credit is a short term facility, right? RBI guidelines say the normal period of a packing credit is usually up to 180 days from the first date of disbursement. In practice, most bank we sanction as it for 90 to 120 days, but according to RBI guidelines, it's you can sanction it to 180 days, right? Now why 90 to 180 days? Because this align with the production and shipment cycle. If you need an extension beyond say 180 days, you need to go to your bank, ask them with her and give them a written reason, and they will typically charge you a little higher interest rate, but they can give you the extended period. Okay, now what are interest rates? Packing credit interest rates. um, here's what where exporters I have seen often get a pleasant surprise. Packing credit interest rates are regulated and are linked to banks base rate or say MCLR. Not usually what the loans are linked are to RLLR. No, these are linked to MCLR or most commonly banks base rate. Okay, Now, banks typically charge lower interest on packing credit compared to your working capital loans. Whenever you see a bank's website, you can see MCLR or bank's base rate are often max 99.99% less than RLLR. Okay. Now, banks typically charge lower rate on packing credit, right? Now, why is this? Why does the bank do you a favor? Because this is as per RBI guidelines. RBI has directed them to support the export finance, which you can just go to RBI's website and just see that. Now, as per recent guidelines of RBI, the rate of pre-shipment rupee export credit is typically just 2 to 3% point lower than the normal working capital. Just say if your working capital is at 11%, then your PC will be normally 2 to 3% lower than your working capital, that can be around 8% or maybe 7%. That's a quite big difference. Now, for foreign currency packing credit, that is we call PCFC, rates are even lower, and they are linked to usually LIBOR. This is the rate of interest. Okay. Now, bankers insight is here. Always ask your bank to give you PCFC option if you have an LCFC denominated in say USD or maybe euro. If this is the case, always ask for PCFC facility. Now, the interest rate savings are significant, especially say if you borrow for more than 1 CR, it usually gives you a very huge gap. Okay. Now, this is the section I want you to pay close attention to, because this is where most exporters lose the plot. Now, when a packing credit application lands on a banker's desk, I have seen that there are you think that if my CIBIL is good, bank will accept it, but we as a banker do not just only look at your CIBIL. There is a whole credit assessment framework. Now, I will tell you how just these 5 things we scrutinize very closely, and just you need to be cautious for them. First is genuineness and quality of the underlying export order. Now, our first question is, if you come to us with an order or CLC, we will ask, is the LC or export order even authentic? Sorry, is it from a real buyer? Now, banks will always verify the LC through their trade finance team. Okay. Now, a first time buyer from an unverified country will raise a red flag, not only for you but for a banker. If you are if you are exporting to a buyer with whom you have a track record, then that's a positive signal and a go signal for a banker. Now, second we look is exporters track record. Now, have you exported fine before, or what are your past export realization figures? Bank looks at your historic export performance from your EDPMS report, that is the export data processing and monitoring system. This is maintained by RBI. Now, if you are a new exporter with no track record, expect more due diligence. Yes, and maybe you need a collateral in this case if you are a new exporter. Now, number 3 is ability to execute the order, that is your operational assessment. Now, this is mostly underrated. Banker assess whether you actually have the capacity to fulfill an orders. Now, do you have say factory infrastructure, or do you have the sufficient workforce, or can you deliver that order on time? We look at your installed capacity versus your order quantity. Now, say an order for 10,000 units, but you say you can only produce 3,000 units, then this is a red flag. You will say a big no. Now, number 4 is margin and drawing power. Now, what is this? Now, bank don't fund you 100% of your value, right? There is always a margin, and this margin can vary from 15 to 25%. So, if your order is worth say 1 CR, then bank will usually finance you 75 to 85 lakh. And your drawing power is calculated based on your stock statement, value of goods to be shipped, and this is reviewed regularly. This is the most where I have seen my customers fail. They think, no, my order is this and I need to get 75 to 85. No, Your drawing power is fixed on you based on your stock statement and book debt statement. Okay. Now fifth is, which we look most, is end use monitoring. Banks are obligated to monitor that your packing credit facility is used specifically for the export transaction, not to deliver to other business users. No, and this also bank looks that you are not using it for any domestic order. Now, how is this done? This is done through the stock inspection, your invoice verification, and scrutinizing your shipping document. Now, if bank finds there is a diversion, the bank can call back your entire facility instantly. Yes, you need to repay back all the loan, and maybe if you are not able to do that, then clean loan rate interest applies. And here is a red flag for bankers: unexplained delays in the shipment after drawdown of packing credit are a major warning sign. And if an exporter draws funds and then takes 5 months to ship, please always investigate why is he doing so, right? Okay, now let me give you the core documentation you will need when you apply for your packing credit limit, and I will call this as a CA ready document pack. Now, from the exporter side, number one is your export or order or say letter of credit. Now, this is non-negotiable. Without this, there's no packing credit limit. You need export order and your letter of credit. Number two is KYC document like your PAN, GST, IEC code, that is importer exporter code, and your firm's registration documents, depending on the type of constitution your firm or say company is. Now, number three, last 3 year audited financial, that is your balance sheet, P&L, and your ITR. Number four, your bank statement for the last 12 months. Number five is stock statement if you already have an inventory. And number six, details of existing borrowings, that is your say your loan account statement, your sanction letter of existing loans, whether you have borrowed from any bank or NBFCs. Now, from the transaction side, the LC or export order authenticated and complete. Number eight, details of foreign buyer, their name, their address, strike code, if anything you have. And number nine, come projected cash flow, showing your projection timeline, expected shipment date. Your CA or your accountant can prepare that. Now, here's a banker tip. I've seen the maximum delay in packing credit processing is due to incomplete documentation. So get your CA to prepare clean indexed file with all the documents before you go to a banker. Now, bank will respond faster to all the prepared say applicant or borrowers who come with all the documents. Okay. Now, after after reviewing thousands of applications, I have seen the same mistakes come up again and again, and here are the few ones that I think matter most according to me. Number one is applying to wrong bank. Now, not every branch has a trade finance team. You need to know this. I have seen many, they come and they just again and again just go. Now, if you walk into say a small branch, maybe scale 2, that handles only retail accounts, your file will sit for months. Please always approach a branch that is actually designated for trade finance or say a large corporate banking setup. Now, mistake number two, under reporting your order book. I have seen some exporters, they try to stay under GST radar or for other reasons show smaller export orders, and when you go for your loan application, this backfires you. Banks want to see the full picture to sanction adequate limit for you, because inadequate limit is of no use for you. Mistake number three, not linking packing credit to post shipment credit. Now, packing credit and post shipment credit are two parts of the same export cycle, right? Now, if you're getting packing credit, you should simultaneously set up your post shipment facility. Yes, I'm talking about post shipment. Okay, so that once you ship, you can negotiate your documents immediately and the loans get prepaid cleanly. And mistake number four, treating packing credit as general working capital. This I have seen the most. and this is called diversion, and banks take it more seriously. Now, if you use this packing credit funds to pay salaries to your workers, buy equipment, or maybe cover other business expenses, then you are violating the terms of facility. Okay, and now this calls to to call this animals bank to call back your facility, and maybe your the packing credit or export facilities can be cancelled immediately with immediate effect by the bank, and it also can hurt your credit rating forever. Now, mistake number 5: not negotiating the margin requirement. Banks have flexibility on margin, and if you have a strong track record or you are a rated buyer and a clean credit history, you can negotiate for a lower margin. And I have seen most exporters don't even try, they just leave the money on table. So please always negotiate not only about margin, for better sanction terms and condition to your bank. Okay, now let's quickly summarize all this. Pre-shipment finance, or say packing credit, is the lifeblood of every export manufacturing. It bridges the gap between you winning an order and getting paid for it. Okay. Now, if you are an exporter, you need to know your type of packing credit, prepare your documents properly, and negotiate for margin rates and better terms and conditions. Now, if you are a banker, assess the genuineness of the transaction, the operation capacity of the exporter, and monitor the end use closely. Now, if you found this video useful, give it a like, and it tells me you want more of this kind of deep dive content. And in the next video, I will be covering about post shipment finance, what actually happens after you ship, and how banks fund your receivables, and why export bill negotiation different from discounting. I'm Sangeeta, and this is Smart Fit with Sangeeta, where we learn banking from the inside and out. See you in the next video. Thank you.